Bloomberg Audio Studios. Podcasts, radio, news.
This conversation going now with Rob Arnott. He is chairman and founder at Research Affiliates, joining us on set. Great to see you in person, Rob.
Yeah, thank you both very, very much for wearing green to celebrate the launch of our new ETF in the crowded space of cap-weighted indexing.
Well, you made my transition for me, so I thank you for that. Let's talk about this ETF that you launched last week, the Research Affiliates Cap-Weighted US ETF. This tracks the Research Affiliates Cap-Weighted Index. And Rob, you made the bold claim that this could represent a new future for passive investing. Tell us about this product.
It's actually very straightforward. Cap-weighted indexing has an enormous Achilles heel. People think active versus passive. Cap-weighted indexes are passive. Yeah, they are, but no, they're not. There's 4 or 5% turnover per annum on average. So 95% of the portfolio is blissfully uncaring about whether the stocks are going up or down, whether the businesses are flourishing or floundering, and 4 to 5% is traded. That 4 to 5% is active, and boy is it wild active. It would make Kathy Wood blush. It buys stocks at an average of twice the market multiple. It sells stocks that are deeply out of favor, unloved, and typically half the market multiple. It chases a frothy emerging growth strategy. All we're doing is saying, wait a minute, this leads to flip-flops. For every new Tesla or NVIDIA that gets found and added to the index, there's a dozen companies that come along that look super promising, that turn out to fall short of lofty expectations and crash right back out of the index in 5 to 10 years. We call these flip-flops. They do enormous damage. What if you just add a little bit of patience? You add stocks to the index when the business is big enough to matter. Not the 500 largest market cap stocks, the 500 largest businesses. And you sell stocks when their business is no longer large enough to matter. Now, if you do that, you slow down the trading, you have lower turnover, it's more passive than conventional cap-weighted indexes. And when you go back over the last 34 years, you find this really simple change boosts returns by 69 basis points per annum with about 1% tracking error.
No, so, okay, this is RAUS, the ETF that tracks the index that would do this.
Correct.
And it is actively managed. So you're basically having a person time the market, is that right?
It is not actively managed. It is every bit as passive as the Russell 1000.
I see.
It's more passive than the S&P, which is managed by committee. It has turnover that's lower than the Russell 1000. It has turnover that's almost identical to the S&P 500, and the turnover doesn't chase fads and bubbles and doesn't bail out of a stock when it's wildly out of favor. That's where the value added comes. It is a passive strategy.
Looking at the holdings here, it looks a lot like the S&P. I mean, you've got NVIDIA, Microsoft, Apple, they're all there. Let's talk about strategy, right? This is a case where the S&P, we qualified, but the committee, who knows who they are, decided, no, we don't like it. It's also not in yours, so it's interesting there. Talk a little bit about what really is passive and what determines whether a stock gets in here, and maybe strategy is a good example. Why isn't it in here?
Well, I love your framing this in terms of active versus passive. There is no such thing as a passive portfolio. Every portfolio has turnover. That turnover can be based on rules, as at Russell. It can be based on committee decisions, as at S&P. Better to define passive as sitting placidly and going with the flow. Well, sitting placidly and going with the flow applies to 95% of the portfolio. It's also interesting that our strategy has 95% overlap with the S&P 500. 95% of the holdings are identical. The difference is at the margins. There are companies that are not yet big businesses that don't make it onto our index. Palantir is the largest market cap stock that we don't own, but it's not a big business. Trades at 100 times its annual sales. And at the other end of the spectrum, there are companies that are big businesses that aren't in the S&P because they've never been popular or frothy enough to make it into there. There's a wonderful example of flip-flops. Dillard's department store. It's been a member of the S&P 500 5 times in the last 30 years. It's been kicked out 4 times. It's come back in 4 times. Every time it's buy high, sell low. Now here's an astonishing fact. If you owned Dillard's during the 13 years in the last 35 that it wasn't in the Russell 1000, you would have made 67 times your money.
Oof.
If you owned it during the 23 years that it was in the Russell 1000, you would have made 99% negative loss. You would have a penny left of every dollar you started with. So a 6,000 to 1 ratio of wealth, owning it when it's not in the index versus owning it when it's not. Just absolutely mind-blowing.
Well, Rob, you bring up Dillard's, which is an incredible example of this, but bringing it back to, I mean, this ETF, you said it has 95% overlap with the S&P 500. So we're talking about large cap names here. How does this effect look when you think about mid caps, when you think about small caps? Do you have the same sort of flip-flopping that you might see when it comes to the S&P 500?
You do, but it's more powerful at the large cap end of the spectrum. Think of it this way. When Dillard's is not in the Russell 1000, it is in the Russell 2000. And so what we find is that every time Dillard's is added, it's added after an average of a 50% outperformance year, 5,000 basis points. Then it underperforms by an average of 6,000 basis points and gets kicked back out. Then it snaps back by an average of 210 percentage points of outperformance, 50% of that in the last year before it's added, and then it's kicked out. Lather, rinse, repeat. It's wild.
Rob, before we let you go, we got to ask you about the president's proposal. It's not official, but this idea that companies report earnings every 6 months, then every 3 months. As an investor, what do you think of something like that?
I'm a libertarian. I prefer to let people and businesses do what they want. I think a requirement of every 3 months, fine, lift the requirement. If a company wants to report every 6 months, every 12 months, that's fine. Publicly traded, it ought to report at least once in a while. But a requirement for quarterly reporting increases short-termism. I've often said that I will never, ever work for a publicly traded company again. I've been saying that for a quarter century. And the reason is regulatory distraction and short-termism. I can think about business. RAUS, the new ETF, RAUS. Yep. We're pricing it at 0 for the first year. The beauty in that is scale. If we get in $100 billion, multiply that by a 0 fee, and that's a lot more money than $100 million times 0, right? I'm joking. We're able to do that because we look past the coming quarter. We want to create a revolution in indexing. And if we create a revolution in indexing and it succeeds, it'll be a big moneymaker in 10 years. I don't care if it's a big moneymaker in 5 years. I certainly don't care about the first year.
Yeah, and certainly not the first 3 months. Rob, fantastic to get some time with you, as always. That is Rob Arnott of Research Affiliates talking about, of course, his new ETF, ticker RAUS.